Good afternoon. We can start the discussion on the central bank before moving into the money supply process. In the central bank area that we have covered mainly in line with the Fed Reserve system, we have discussed very much up to the so-called concept of independence. So we have come to the point, and probably you would have listened to the last week's recording that would have played for you all, where we discussed about so-called the independence. So we will start the independence area, and then we will move on to the new lecture. That's money supply process. So this independence also one of the very important areas of discussion, simply because we have seen in today's discussions on financial markets, and also in terms of the existing circumstances of COVID and other related developments, the central banks all around the world are facilitating the development objectives, if not development goals, of many countries, including US. And in that process, they are maintaining a reasonably accommodative, please remember, accommodative monetary policy stance. So this accommodative monetary policy stance comes from both the maintenance of low and stable cost of financing environment, but also from a perspective that the markets are sufficiently liquid in terms of respective financial markets financing and liquidity requirements. And for this exercise, central banks are increasingly active in financial markets, particularly in the money market, through their open market operations, or for that matter, statutory reserve requirements. You know what's conventional monetary policy tools? We just mentioned those stuff when we discussed the Fed Reserve, right? And the discount window, right? So open market operations, statutory policy, a statutory reserve requirement, as well as discount window. They are injecting substantive amount of money into the economies, and this continues not only in advanced economies but also across majority of emerging, frontier, and developing economies. And how independent in terms of these measures is another very interesting question now being discussed all around the world. Sometimes the central banks, even in advanced economies, being pressurized by political authority. Even if you see the developments in recent years in US, the US recently ousted President Donald Trump was openly criticizing Fed chairman. Okay, Fed chairman Mr. Powell was openly criticized and at times been kind of influenced to make decisions. But then the Fed was maintaining a stance in terms of how they look at the economy and how they look at the economy's perspectives. And this was pressurized to see the US was tightening some of their policy measures. Interest rates started to increase. The noise was very much during that period. But then with the COVID, onset of COVID and other related developments, the central banks, even in US, they have started accommodating, reducing the interest rates, injecting a lot of liquidity, buying a lot of assets from the market, financial assets. And then the government also more or less live happily with the central bank's initiatives. And this is no different in terms of what we are seeing in Sri Lanka too. In Sri Lanka too, at one point, His Excellency was in fact, openly kind of pointing finger at central bank, not doing much expected. But seems central bank was doing, but they are not trumpeting what they were doing all that time, right? So possibly His Excellency was not being briefed to the extent where the information in terms of what central bank was doing being communicated, highlighted, and taken notice of. And majority of the actions since the COVID in Sri Lanka in terms of accommodative and facilitations coming mainly from central bank. Yes, government also facilitated few points, but very interestingly in terms of extending credit lines to industries who has very much hit from COVID related developments. And on top of that, extending facilities to financial intermediaries on a continuous basis, and a number of SME and targeted sector loan schemes being introduced. And then on top of that, you probably noticed central bank was continuously reducing the policy interest rates and also the statutory reserve requirement. These are Sri Lankan cases, right? So you can see the kind of role the central bank was playing all throughout. And then now in recent media and discussions, even in Sri Lanka, there are arguments to say that central bank is printing money, right? So these are all linked with so-called independence that you are talking, right? So the central bank independence, when we look at, we have highlighted these elements in our last discussion: instrument and goal, what instruments that they have, conventional, non-conventional, what is the goal? Of course, the goals could be set by the parliament, right? And they can change through parliament legislations. But still, once the goal is set, right, how best central banks could act upon it, right? Appointment of the key personnel, including the governor, right? Then the revenue independence of the central bank, right? So there are various things, right? But what you have to see in terms of most of these countries, including US and other OECD countries, is how political influence works in terms of these institutions operating on their independence against central banks' actions, operations being influenced by political authorities, political will and fancies, right? So there are various ways of looking at this, and we discussed these features in our last discussion, but then we look at how independent and argument whether the central bank should be independent in the first place, right? There are two arguments for this. One is the case for independence and case against independence. Okay, so the case for independence strongly argue that independent central bank rests on the view that subjecting central banks to political pressures would impart an inflationary bias to monetary policy. And all around the world, central banks are often looking at what as one of the main goals, if not most important goal in terms of their central bank activities, is maintaining low and stable inflation. Low and stable, right? For some countries, the low means 6%. Some countries, 4%. For some countries, even achieving 1% of inflation is absolutely challenging, right? So low and stable depends on their economic circumstances, and maintaining at that low level for a longer duration is one of the important objectives of most of the central banks. So leaving out this independent objective of the central bank and letting political authority to influence central banks would end up these countries not being able to achieve the low and stable inflation, because politicians and political authorities are so happy, so keen to push central banks continue to accommodate, supplying money, buying assets, maintaining low and stable interest rates, because they don't want to see central banks pushing for increasing interest rates, because that invariably increase the cost of financing, and through which it could delay expansion or investment activities, but requires, because you require to see the economy is also falling in line with the overall the level of the baseline level of its economy's capacity. So letting it beyond its capacity, you will find the economies are overheating, and overheated economies would end up having higher inflation and thereby eroding its asset base and wealth over a period of time. So the central bank's independence strongly argue that letting political authorities to influence central bank would end up inflationary bias on monetary policy. Then the argument why central bank should not be given independence. Okay, and they simply say the Fed under the control of the president or Congress argue that, okay, is undemocratic, right? Because they simply see people have elected the political authority, people have elected the parliamentarians or the Congress, right? But the monetary policy and the conduct of monetary policy being handled by very few, if not handful of people, right? So they argue that is not democratic, okay? Because the actions of central bank would impart influence across all the subjects of a country, all the people of a country, right? So this group, small group, is a influential allied group. They are not responsible to anyone. That's the argument for case against independence. But it's not right to say that they are not answerable to anyone. They have been repeatedly required to present themselves and defend themselves in commissions, committees, parliamentary, senate, presidential, whatever, right? And then, of course, the actions being independently audited and being audited through special commissions, right? And also the actions being looked after through various performance yardsticks. If you are not in a position to deliver on your inflation target, if you're not in a position to see that you've been able to manage your economy on a reasonable shape, except influences which are beyond of anybody's control, right? And maybe despite political authorities' influence, if you are capable of maintaining a reasonable stability across the economy, there are various ways of measuring these people's activities, right? So the argument against is more or less the governance in democracy related. But arguments for is mainly arguing that you should not let political authorities to influence, because that would end up having inflation in the economy. So this is the base for independence argument. Any questions before I move on? Right? So you see this element, this being widely discussed, widely kind of presented at different forums, and also the argument for independence, okay? Already said about the political pressure would impart an inflationary bias to monetary policy. Then political business cycle. Political business cycle is the generally, you know, the election cycle of general versus presidential, then other smaller jurisdictions in the form of provincial, state, local authority election cycles. So what you are basically seeing is 5-6 year cycles or 4-5 year cycles, depend on the constitution of these countries. So the political authority would prefer that the economy is performing and monetary policy remain substantively accommodative closer to election times. But it is not necessarily something policymakers or the central bankers would look at it in that way. They would look at whether it's accommodative or a tightened monetary policy stance being maintained based on not political but economic business cycle. So the economy is going in a downward trajectory. The growth are low, inflationary pressures are low, inflationary expectations are well anchored. Central banks would continue to accommodate or maintain accommodative monetary policy stance. But in cases where a political business cycle is concerned, for them, what matters is getting elected. So they would push central banks for, right, continue to have, even at times where the central banks requires to tighten its monetary policies, they would not let central banks to operate independently in such circumstances, because their political business cycle is important for them. So to see that why central banks need to be given independence comes from the argument that you can actually work on the basis of business, economic business cycle, and not political business cycle if you have the independence. And then independence required is central banks could be used to facilitate treasury financing of large budget deficits. When the government wanted to see the interest rates being maintained low, not letting interest rates to adjust in line with market supply and demand circumstances, right? So it's a treasury, the government's Ministry of Finance, General Treasury. They require substantive deficits being financed because their expenditure is not in line with the revenue targets. Of course, there may be circumstances like now the COVID in most of the countries where economic activities remain subdued. People cannot get on with their day-to-day general economic activities. Then there seems some argument to say some facilitations required, but not necessarily all throughout the general period. And the central banks being pushed to finance government's budget just because government is not managing its fiscal outlook properly, right? Persistent or perennial deficits, fiscal deficits, would push countries' the inflation numbers and debt level to increase, and these debt levels being financed through central banks would further increase possible inflationary pressures and reduce the value of the real resources, right? So independence is required for that purpose too, because then you can evade or you can protect yourself from treasuries pressure on budgetary financing. And the other element is too important to leave to politicians, right? The principal agent problem is worse for politicians. And principle of politicians is you, me, general public. Agents are the politicians, right? So once they get elected, they become principals and they don't see the role that they need to play as agents. But what you see here is, as agents, they try to maximize their own welfare and the benefit through influencing central banks' independent decision-making process. So the case for independence argue all these things. And you probably see, and in Sri Lanka's case too, there are a lot of discussion in line with some of these elements in today's financial press. You can also kind of, read through them, and it is an interesting area to explore in terms of not only enhancing your knowledge for the examination, but also in terms of interpreting how the financial markets behave, operate, and looked at in today's circumstances. And case against independence. You already know the undemocratic argument. And then there's another argument, unaccountable. Central banks are up to themselves. They are not accountable to anybody. I believe this notion is not necessarily right in today's context, because central banks are also under the audits, and also the central banks required to act, perform based on its legislations. They can breach those legislation and the kind of general framework of performance. And yeah, unaccountability also kind of, not been something that the central banks can accept, simply because their actions being monitored not only by these subjects, that means the people in its jurisdiction, but also by the rest of the world, because the markets are so interlinked in today's context. So you act unwisely if not your actions are not in line with the best standards of actions expected of a central bank, possibly you would not be able to match your counterparts and work in collaboration with your counterparts in rest of the world, simply because the financial markets requires you to work, and your kind of a role in international financial system get diminished. So the case again, independence might argue unaccountable, but it's not necessarily right to say unaccountable because of the circumstances and the environment and the legislations govern central banks in today's context. And the other element is difficult to coordinate both fiscal and monetary policies. Monetary policy requires stability, low and stable inflation most of the time, and financial system stability. When monetary policy see the inflationary pressures are building, the monetary policy would push for tightening monetary policy stance, increasing interest rates, reducing liquidity, right? The possible statutory reserve requirement increases, if not other measures through which they would try to maintain inflationary pressures being managed. But what higher interest rate means is cost of financing of the government would increase. So the government would argue, no, I have to have big budget deficits. So I had to make budgetary finances. If you increase the interest rates, the interest cost of these finances would go up. That would further increase the budget deficits. So the collaboration, coordination between fiscal and monetary policy become very challenging in such circumstances, right? You sacrifice inflation objective, and effectively from your the kind of a learning you have seen that real interest rate and expected inflation and the nominal interest rates, the Fisher equation, right, all will come and play a role here. So ultimately managing inflation would bring in much more desired results, but the politicians or the fiscal policy would not have that patience, right? So what happened here is the difficulties in terms of coordination, and that's why in some countries the fiscal authorities being kept aside from monetary policy decision-making bodies. But in Sri Lanka, as you already know, the most important decision-making body of the Central Bank of Sri Lanka is the Monetary Board, where Secretary to the Treasury or the Secretary to the Ministry of Finance is an official member. So he has the government's point of view being discussed at the Monetary Board and presented in the Monetary Board. So naturally, he would have second thoughts when it comes to a monetary policy tightening cycle starts, right? So these are the elements, I mean, people would argue against independence, okay? And also there's another argument, central banks being given independence, but they have not acted or used this independence successfully. The country is having inflations despite central banks being given independence. Country is having the other instabilities, financial systems being heavily influenced and challenged by various possible bank runs and things like that, right? The market has lost confidence of the financial system and financial intermediation. There are various arguments at different times across different countries, including advanced economies. But this is not necessarily something to say that central bank has not necessarily used its independence successfully, but there are other elements that would have prevented central banks from acting on that basis. So there are a lot of arguments for and against in terms of this independence, and you also can go on and deliberate on these topics in detail, and you can actually justify on what basis that you are arguing for or against, right? So these are open-ended areas of discussion, but generally more and more the authorities and the countries are favoring central bank independence in recent years. Then looking at central bank behavior, there are various explanations. And one view of government bureaucratic behavior is that bureaucracies are serving public interest. Okay, this is the public interest view. You have to serve public interest. What public wants, you have to deliver. Okay, but the thing is, at times public would see the immediate short run or the benefits that they see in front of you, not necessarily beyond certain levels of certain duration. Okay, that's why some economists have developed a theory of bureaucratic behavior that suggests that other factors that influence how bureaucracies operate. Sometimes the public interest view is required, but then interestingly, public interest over a longer duration, longer period of time, need to be factored in this central bank's behavior to great extent. Okay, and the theory of bureaucratic behavior may be useful guide to predicting what motivates Fed and other central banks, because there are arguments that bureaucracies wanted to concentrate power, retain power, influence being maintained. Within the bureaucratic behavior theory, this has been explained. So you have to generalize the fact that why central banks wanted to see this small group, an influential group, being maintained rather than everybody else's, the general public's opinions, views being brought in. It's not that they don't look at those, they look at those very seriously, but then you have to act upon it. Just because a party is going on, central banks cannot continue to let party to continue if they see the inflationary pressures are building. So you have to take a view, take a decision on that basis, and then everybody else would not be happy. Majority of them would say, no, you should not, you should do other things too. But it's a way in which central bank has to perform its function. Okay, and then of course the other element in terms of explaining the behavior is the bureaucratic behavior might argue the maximizing own welfare, which relates to power and prestige, right? And because of this reason, central banks would argue for their independence and also avoid conflicting with other powerful groups, including politicians. So when the politicians request, they somehow try to accommodate those political authorities, influencers, rather than kind of maintaining their pure independent decision making. And this being again argued not only in emerging and developing economies, but also in advanced developing economies, right? But this does not mean that the central bankers do not have altruism, and they look at broader a magnified view in terms of what countries overall requirements in terms of what they wanted to do, right? They look at the well-being of everybody as a whole, right? So they wanted to see the overall benefits and welfare to the economy in their decision making. Okay, so that explains to great extent what central banks act upon in terms of its independence, and how they sometimes look at the role of this influential group of people in terms of their behavior. So we can look at now to some extent other major central banks, how they structure and independence of these central banks throughout the world. Any questions? Right. Okay. So now the ECB, European Central Bank. This was established with the establishment of the Eurozone. But interestingly, the concepts and the structure was patterned very much in line with the Federal Reserves. You know, Federal Reserve districts, Federal Reserve banks in different Federal Reserve districts. Likewise, in ECB, now you don't see national central banks playing a single central bank's role. You may see in France, you may see in Germany, you may see in Italy, Spain, all Southern European countries, and other ECB members. And UK is independent, and they are not a European central bank members. And recently they also voted in terms of Brexit to move out from Eurozone, right? So that would have other trade and related compulsions over that decision. But interestingly, the independent national central banks in different countries, different jurisdictions of this Europe, would not necessarily act on their central bank's own independent objectives. What now they have to act upon is the ECB's independent objective, and the national central banks would look like Federal Reserve Board of Governors is the ECB now, that's in Frankfurt, Germany. But what other national central banks in other part of the world, in Europe, would look like as Fed Reserve different districts and the Fed Reserve banks in different locations. So they will more or less carry out ECB's monetary policy decisions. Okay, so then each country central banks would play a similar role to Fed Reserve's different Fed Reserve district Fed banks, how they act in US. But interestingly, ECB also, right, have a very, very interesting structure where the executive board is concerned. The president is the head of this executive board. This executive board is a 6-member committee, president, vice president, and 4 other members, right? These members are rotationally picked by member states, and they get an 8-year term, whereas in US you saw 14-year term, right? And non-renewable, once you elected for 8 years, you will not necessarily get an opportunity to serve beyond that. In US also 14 non-renewable, but you can opt out before that period lapse. You can resign if required. And then the governing council is the major decision-making board. Executive board would present their policies. That's the one that generally makes the operational and the decision, but governing council would make more or less the broader decision for the European system, central bank system itself. And differences in terms of right, the central banks in European system of central banks, ECBs, and the Fed Reserve system is, in the Fed Reserve you saw the each bank's budget also comes under the Fed Reserve's budgetary purview. But in the case of ECB, the national central banks control their own budgets, and ultimately they are the ones again have a say on ECB's budget too, right? And then, of course, the monetary operations is decentralized. It's not centralized in the case of ECB, right? So they have different member countries having different aspirations, different level of development in their growth cycles. Okay, and they have given a reasonable space to operate in terms of their monetary policy circumstances, but within a broader ECB framework. And you know, some countries are reasonably poor, some countries are very wealthy in the ECB, and then you cannot expect the poor developing smaller economies also to have a deficit targets like much advanced, much developed countries in the ECB. So there's a difference across different members. So harmonizing these differences through various arrangements they would be following up, but strictly adhering to such rule-based structures is very difficult in terms of ECB. They had a deficit rule, but it's very difficult to influence on that basis. And the ECB does not do the financial regulation, financial supervision, whereas Fed does. In the case of Europe, it's a Financial Services Authority, FSA. That's the agency that follow up in terms of regulation and supervision, not the European Central Bank. Then the Governing Council, as I was mentioning, as the most important decision-making body of the ECB, they meet once a month in Frankfurt, Germany. That's where the headquarter of ECB is located, and there, apart from 6 executive board members, 12 national central bank heads represent. So it's 18 members. And these 12 national central banks are out of 22 countries at that time. Now it's expanding. So what you're basically seeing here is rotationally, the national central bank heads get elected to the Governing Council for different periods. So the operations here also by consensus. They don't take vote in their decisions. Often most of the decisions are agreed by all the members. Okay, and ECB, European Central Bank, look at a target interest rate and then act upon that target by open market operations, so asset purchase programs, whatever that they think it's right for them in order to maintain that target level of interest rates in the European economies, right? So as new countries can join, existing countries can go out from European Union, right? Governing Council, as I was mentioning, would function on a rotation system, because they had to facilitate the newcomers, they had to facilitate whoever opting out from existing arrangements. And how independent the ECB is, that is also a very interesting question. And to great extent, people say ECB is most independent because you see the ECB might be, the executive board or the Governing Council may be run by members who do not belong to any of the countries in the region. They are that independent. They come from various other countries based on their merit. They've been recruited and they act upon their objectives. But it's not necessarily the case. They also work very closely, coordinatively. For instance, Mario Draghi just recently been elected as Italian Prime Minister, right? Being asked to run the country's economy. He was the outgoing, recently outgone ECB president. Now it is Christine Lagarde, a former IMF chief, IMF president, managing director, IMF managing director. She is the one now heading the ECB. But prior to that, Mario Draghi, Italian, and he been asked to take over the country and run as the prime minister by the president, and he has now got the parliament approval also for his policy. So it's not necessarily something that you can separate it out in terms of political authority and other related things in independently operating European Central Bank. But interestingly, from a structural perspective, ECB remained the most independent, because you may be not belong to any of the jurisdiction from a technical perspective. And they have long terms, 8 years, it's reasonably long. And they have their own budget. But their focus is achieving price stability. That's the goal, not anything. Other things they can focus, but ultimately they have to work towards price stability. So this being pinpointed as restrictive in terms of ECB's goal independence. But what ECB tries to do is they try to link everything else towards this price stability objective, and through which they try to present themselves that they're acting towards overall objectives envisaged for the ECB, right? Even in recent times, they were looking at a lot of accommodative monetary policy in terms of asset buying and things like that, in line with maintaining low and a stable inflation. That's the price stability objective is. And the other thing is, ECB's charter is very difficult to change, not like parliamentary legislative approval. And the ECB charter was formed through the Maastricht Treaty. All the countries of European Union signed this agreement in unison. But unfortunately, now when they wanted to do a change, different countries have different view. So it's very difficult to bring in changes to the legislation. That stubbornness of the legislation itself gives the independence for ECB in terms of their operations and their actions concerned. Right. So then you see other major central banks: Bank of Canada, Bank of England, Bank of Japan. In fact, Bank of Japan got the Bank of Japan law, much more independent law being passed only in 1998. Prior to that, they had the Bank of Japan, but more or less they had to work in line with the General Treasury's influence. Okay, so there's a greater kind of a push towards independence in central banking all throughout the world. So I'll stop at this point in terms of discussing the central bank structure, goal, the way in which that they work and their independence, that discussion. Any questions before we move on to a new topic? Right. So we can move on to the money supply process. This is very interesting and very important area of discussion. I hope we would need, if not we require, to complete our classes by next week. So we might finish the course lectures for this semester very much with the money supply process. If not, I would discuss about central banks, tools, and operating models and things like that in the next class. But I believe the money supply process would take more or less the entirety of discussion this week and the next week. So this area is quite interesting, because you already know the movements in money supply. the quantum of money available in the economy that would influence the interest rates, right? And also the overall health of the economy that affect everyone, every subject of that jurisdiction. The central banks would target interest rates. That's directly they do. But at the same time, once they have that target, to maintain around that target requires them to kind of, act upon through various policy tools that they have. So they use the changes to money supply in that direction. But at times, if they see inflation pressures are vastly subdued, right, they would continue to maintain a reasonably accommodative monetary policy stance and thereby a reasonably high money supply condition in an economy. But interestingly, because this affects the interest rates and the overall health of the economy, right, we need to understand how the money supply is determined, who controls, and it's central banks in the discussions that we just concluded. What causes it to change, and how much this control be improved through the changes to the money supply process and things like that. So that's the focus of this section, and we try to answer to these questions by providing a description of the money supply process, okay, and the mechanisms that determines the level of money supply. You will see that how we build these small building blocks and kind of try to build the overall structure of the house, right? So the deposits at banks remain one of the largest component of money supply. There's no argument with that. But in today's context, it could still change because with the accommodative monetary policy stance maintained by most of the central banks all around the world, the asset buying programs would change the a substantively big component of deposits of banks within the money supply component, okay? And it's interesting anyway to see that how these deposits are created in the first step in understanding the money supply process, okay? So in terms of how these deposits are created and what's the basic principles of this money supply is what we are trying to focus through this discussion and the discussion that we will continue towards next week's class. And you already know the major players, and these major players are the central banks, okay, and the banks, mainly the financial intermediaries and the depositors. This could be individuals, this could be institutions, because the actions would matter in which direction the money supply process would behave. If not, what happened is even if the money supply process wanted to act upon a direction, the depositors or the individuals and institutions' behavior would make amends to the way in which the central banks want to act upon or operationalize their money supply requirements. Okay? So the quantum of money in any economy or the money supply would include currency in circulation. You call it cash and coins. The currency is normally notes, not necessarily people look at coins, but that's also part of the money supply. And then the balances held in checking and saving accounts. A checking is, one could call it current account for easy references. And other near money substitutes. Maybe apart from saving accounts, you may also have fixed deposits, time deposits, So that have a little less liquidity in comparison to checking and saving accounts or currency in circulation for that matter. But what you have to understand here is total value of money available in economy at a particular point of time is known as money supply. And this money supply could be different aggregates, often represented by a big M, capital M, with notations to say M0, M2, M1B, M2B, M4. Likewise, you see from a smaller M to higher M in terms of aggregates, this M's would change. But these M's would effectively say the everything in terms of the circulation, currency, and other things, and the saving, checking, and other near money substitutes that we would be looking in the form of this process. Then if you look at the money supply process, it is effectively important to understand a central bank's balance sheet. And we will come to a bank's balance sheet, but effectively a central bank's balance sheet where you see asset side and the liability side. So when it comes to liabilities of a central bank, everything you, I, and other subjects in a jurisdiction, in a country, hold in their wallets and kept in many other places, we call it currency in circulation, remain one of the main liabilities of the central banks. The currency they print and put it out to the economic use of a country is one of the main liabilities of the central bank. They have to account for it. They should know how much is in circulation. There may be differences in terms of how to aggregate it or how to account for it based on the depletion of currencies which have been put into circulation long time ago, right? Or damages, various other forms of elaboration. But you should be able to look at it as one of the major liabilities of a central bank's balance sheet. And what is this reserves? This is nothing but the deposits the banks keep with the central bank. You know this statutory reserve requirement. In Sri Lanka, it is 2%. Most of the countries also, it's very low. Out of each 100 rupee of deposits that the banks take, they have to keep the statutory reserve requirement with the central bank. That's 2 rupees. So you have to keep, and this is not central bank's money. This is the money belongs to the depositors of those banks. At one point you had to give, but this needs to be maintained with the central bank for various purposes, and through which central bank could influence the overall money supply. For instance, if you increase the reserve requirement, you have to keep more reserves, right? So what the central bank does also in terms of its open market operation activities is whenever they buy or sell assets to the market, from the market, they change the account balances maintained with them, including these reserve balances. So then the banks knows my required reserves is this much, but in my account now I have more reserves. So they can take out that money and make use of that money in their day-to-day operational activities. Similarly, there are other liabilities in the central bank books. We don't want to get into that. We'll simply look at these liabilities as currency in circulation and reserves for easy understanding. Then what are the assets? In central bank books, all the securities that they buy, by printing money, they buy government securities, treasury bills. So the treasury bills in central bank books is an asset to the central bank. But to buy that, they have put out the currency to the economy, that is liability on the central bank book. When you are buying government securities, you have to pay for the government, isn't it? Government would not give you government securities free, right? Right. Central bank purchasing government securities means central bank has to put the money into the economy. The government will make use of that. So in the central bank size, they create an asset, that is security, by buying these government securities. But at the same time, the payment for that makes the liability side, there the currency in circulation is created. Then the other main assets in central bank's books is the loans. Like other financial intermediaries, banks, central banks also extend loans mostly to the banks, not to general public. So the banks borrow from the central bank, either through overnight open market window or through standing facilities or lender of last resort facilities. There are various schemes central bank introduced. So these loans being taken by the banks are assets in the central bank's books. So the asset is the loan. Correspondingly, the central bank would release currency to these institutions when they request for a loan. This may be discount loans or penal rate loans, various types of loans the central banks extend. Okay, so that's broadly the balance sheet from asset and liability perspective of a central bank. Any questions? Right. Then it is very interesting to see some concepts or the conceptual understanding in terms of the key elements one would see in a money supply process. One element is usually we called as monetary base. Monetary economists, monetary policy makers know what this monetary base is. From another word, the monetary base also called as high-powered money. And this monetary base is nothing but the total amount of a currency that is either circulated in the hands of the general public or in the commercial bank deposits held with the central bank's reserves. Effectively, what this means is the liability side of the central bank's balance sheet. Main two elements that we discussed, the currency in circulation and the reserves. And this is effectively the currency that central bank put it out, that we now in circulation among general public, or general public has brought this into the bank and then the bank has taken part of that as statutory reserves and brought in and kept in the central bank's reserves, and that's the deposits the bank held in the central bank, right? And effectively this is the most liquid. Anytime you can take this and anytime you can spend this, and the easiness in which you can get this in the transactions that you carry out in any economy. So the high-powered money, if not the monetary base, is nothing but the C that is currency in circulation, plus R, that is total reserves in the banking system. So when somebody wants you to talk about the monetary base, please explain and describe in line with what you have now learned. And this is comprised of C plus R. C is the currency in circulation, R is the total reserves. Okay, so this is a very interesting element because this would help you in terms of recognizing and understanding the elements within the money supply process as we move along. Right. So you know now what is liability in the central bank's book, what is asset in the central bank book. Why I presented central bank side of the story, that is easy for us to recognize and understand rather than taking into a bank side book and trying to understand the assets and liabilities. But that is also not different. But for easiness and the way of explaining things for your understanding, we will often look at it from central bank side first, and then we look at how that influence the bank side's accounts. So that would make any efforts by the central bank in terms of money supply adjustments would be understood much clearer and easily. Okay. Now we will look at open market purchase. You know OMO, open market operations of central bank. So the central banks, in a broader sense, based on their monetary policy priorities and the direction, make open market operations that either they purchase or they sell, or there are other open market activities. I'm not getting into repurchase, reverse repurchase, sterilizing. There are various things. We don't need to get into that to complicate you. But very simply, let's assume open market purchase. And this purchase is, in this case, is not from the bank, but not necessarily from the bank, but from the general public, non-bank public. But you know, with the central banks, banks only keep accounts, right? So we will come to that with a little more elaboration, but it's a purchase from the central bank, from the financial market. So when central bank purchase, right, they purchase, assume a security, government security, that is now in the secondary market in the hands of a general public, and central bank is purchasing that. That purchase is $100 million. So when they purchase that, that comes into the central bank's asset side. The assets of the central banks increases by this new security that they have purchased, $100 million. For this $100 million, central bank have to pay now. You don't give free to central banks anything that you want with you. So central bank also don't expect to get anything free from you. They purchase this security, and for that they make the payment effectively, not by releasing the currency to the general public, but by increasing the reserves maintained with the central banks by the banking system, because that general public would ultimately come through a bank. He can't come directly to the central bank. So he might be maintaining an account with, let's say, Bank A. But Bank A would come and do the transaction with that general public in a subsequent stage. But at this point, the security being purchased from him by the central bank, right? Central bank security portfolio increased. Similarly, for that, the payment that central bank has to make, they have settled in terms of increasing the reserves maintained by the so-called bank of that general public with the central bank by same $100 million. Right? So with this central bank action, immediately corresponding action that you would see is in the bank's accounts. So the bank knows they have got new reserves. Reserves are effectively an asset in the bank's book. It's a liability in the central bank's book because that is not belonging to central banks. It belongs to the bank. So the bank's book would have $100 million reserves now being created because central bank has settled its asset or the security purchase for $100 million. With these reserves that the bank received, effectively, bank knows it is not his security that he sold. It is the general public security through the bank the central bank has purchased. So this $100 million reserves that the bank already show in its asset side do not belongs to the bank but belongs to the general public. So it could go out anytime when the general public wanted to take that money out. So they create on behalf of this general public a checkable deposit. Checkable time, okay, current, you name whatever, but a deposit's being created on behalf of this general public. So the $100 million is again reflective in the bank's book as a liability and as an asset, as well as an asset. So liability is the checkable deposit, and the asset is the reserves that they have in the central bank's books created on behalf of that bank. Right? So effectively, the process is central banks do not necessarily deal directly with general public, but for your information that we have shown all this, the banks would be the intermediary acting on behalf of this general public. So they are the ones, the first line of interaction with the central bank in this process. Right? So we will keep this for the time being in our head and in terms of how the liability and asset sides behave. And then what we are simply seeing here is right, the open market purchase from the non-bank public, still it's continuing. What we learned there is still continuing. What happens here is we now bring in the so-called the general public, okay, non-bank public in this explanation for your easy understanding, being represented, and his account also into the equation. So when he sells his security being his asset, that get reduced. Right? So $100 million worth of securities from his portfolio, now reduced in his portfolio, but accumulated in the central bank Fed Reserve's account as securities. We already looked at it. And central bank created reserves for that in the name of the bank with whom this general public is having accounting relationship. Okay. So what you are basically seeing here is security side reduced and security side increased, reflecting the general public's reduction in security, the central bank's increase in security. And originally we have kept this in the form of resource under the name of a bank with whom this general public is maintaining accounts. Right? So as soon as this general public wanted to cash his checkable deposit, what happens is the reserves form maintained by the central bank would change from reserves to currency in circulation. That also ran a liability. And what you are basically seeing is, instead of reserves, this bank is now asking the $100 million equivalent in currencies to pay out to this customer. So currency in circulation increases in the central bank's book, and immediately you see the currency is now in the economy. So effectively, the reserves that you have seen in the bank books, central bank's book and the bank's book, has changed from reserves to the currency in circulation. So there's no change in reserves in such an open market activity. Okay, but currency in circulation has increased to the amount of open market purchase by the central bank. But interestingly, you know, whether it's reserves or currency in circulation, any increase means an increase in the monetary base. Monetary base is C plus R, right? So ultimately, you have seen here the C has increased. So monetary base has increased. So that's the way in which the central banks influence through open market purchases. Similarly, we will come to a open market sale. But before that, we'll summarize a purchase. What it says is effect of an open market purchase on reserves, right, depends on, please understand, depends on whether the seller of the bond keeps the proceeds from the sale in currency or in deposit forms. You may have seen 100 being converted into currency in the last example that we were discussing. That's why it has confirmed that the reserves have not changed. Everything has moved to the currency. But if we kept part of that in reserves, part of that in deposits, then you would see both reserves and currency in circulation in aggregate equivalent to the open market purchase would remain in the books. Okay, but either in the deposit form or currency form, you would see this is reflective. But aggregate, any open market purchase on the monetary base always increases the monetary base by the amount of the purchase. So that's the effect that you have to see. You purchase open market, do a purchase, but whatever form it's been maintained, currency or in deposit form, that would increase the monetary base. So that's the effective message that you wanted to have. Then you see a sale. Now we will not go through the first example where we had the intermediary also in the equation to show you how the bank and Fed Reserve or the central bank's accounts were stacked upon, and ultimately that gets reflected in the non-bank general public. But interestingly, here we take that step out because you have understood it. I presume you understood it. So we take more or less a straight route to see what effect a sale there. Central bank selling securities from its portfolio. Open market operations, central bank hold assets, that is government securities in its portfolio. They sold part of that, again $100 million. Central bank's asset size reduces by that amount. Okay. And for this sale, whoever purchased that, he gets new assets to his books, basically, that is securities, that increases by $100 million. From central bank side, assets reduced, and in the general public, somebody who purchased that, who got this asset, and his assets have increased. But interestingly, whoever purchased that, because central bank would not extend free lunches, right? So has to pay. So he pays through the currency he maintains. So immediately his asset side, because currency is an asset for him, but a liability for the central bank, right? So currency side, this general public see a reduction equivalent to the open market sale that he purchased. So $100 million currency reduction. But interestingly, when currency in circulation that is already in the economy comes back to the central bank in the form of a settlement of a central bank sale, what happens there is already established liability of currency in circulation now out in the economy get reduced by the amount of sale in the central bank's books, as its liabilities now reduces by 100 million in this particular example. So it is basically central bank has put out the currency to the economy, and from that currency to the economy, now 100 million is coming back to the central bank's wallets. Because it's a liability in the first place for central bank, it has returned means by that amount the liability reduces. So that's what you see in the central bank book. Security is reduced, currency in circulation reduced, asset side and the liability side. In the non-bank public, general public side, security is increased, currency is decreased. He sees no change in terms of his asset side position. So any sale would reduces the monetary base, because you know monetary base is nothing but C plus R. Here C reduces by the sale amount, reserves no impact. And here, when it comes to a sale, impact is much more straightforward than a purchase, where decision of the general public whether to keep in the deposit form or in currency form would make how much the reserve impact, how much the currency impact in the monetary base. We have seen that in the purchase example, but here, because it's a currency settlement, it is much more easy and straightforward. Open market operation on the monetary base is much more certain than the effect on reserves. And I hope this is clear in terms of understanding this open market sale and the purchase that we discussed, right? So then we also look at shifts from deposits into currency, right? Not bank public, bank also there, the central bank also there, right? So you see the position in the bank itself, not the central bank. I'm just talking about the bank here. Originally, the checkable deposits they had maintained. And it's a liability because the bank knows once the general public come and ask from you, you have to pay for that. You have to pay that deposit because it belongs to the general public. Although it's maintained with the bank has to pay for it. And the general public also knows in his books it's a checkable deposit. He has an asset because it's a deposit belongs to him. That is with the bank A. So when somebody comes and requests that deposits being converted into currency, in the bank's book, checkable deposits decreases by that amount. Here it is 100 million. And then similarly, the checkable deposits held by this general public also knows now his checkable deposits has gone out because he has converted that to the currency. In his books, deposits are reduced by 100 million and he gets the currency 100 million. But to get this currency 100 million, probably bank would have provided him through converting the reserves in the bank's book, right? Because reserves were there in the banks when central bank originally created that position with on the name of this particular transaction and the bank. So the reserve position is also reduces in the bank's book, as well as in the central banks, it is a conversion from reserves to currency because currency is now requested by the general public. So you see in the bank side reserves reduces, the central bank side reserves reduces, but central bank side the currency in circulation increases because general public wanted that 100 million in currency form. So net effect in a conversion of deposits into currency on monetary liabilities or monetary base is 0. Okay, because you convert C to R or R to C, effectively the other side of the equation remains same. So monetary liabilities remain same on that basis. The fluctuations depends on how much you wanted to change in this case, and monetary base, that's why I said other side of the equation remains same. It's the stable variable is the monetary base. You change C, you change R, but other side of the equation remains same. One has been increased, one has been decreased. So the aggregate remains same in this exercise. And similarly, like purchase, sale, shifts, there are also other ways through which the money supply gets adjusted in an economy. And another very interesting element of this adjustment is the so-called loans to the financial institution. As I was mentioning to you, the financial intermediaries often comes to the central bank in terms of their liquidity requirements, in terms of their financing that they don't want it to come to the market and raise. But by pledging collateral, they could raise from central banks. And also at times where they are having great difficulties, come to central bank as discount lending facilities or a lender of last resort lending facilities. And central banks also at different times in the economy, like now what you are seeing in terms of COVID and other related developments, they also could introduce various possible lending schemes for the general public. So financial intermediaries come to the central bank and loaning money, loaning facilities. So when there's an extension of a loan, what the central banks does is it creates an asset in the central bank's book, right? Like securities. Now a loan, here again, we take 100 million as the example, $100 million. So it's a borrowing from the central bank, Fed is US central bank, right? So asset side of the central bank increases by 100 million. And similarly, liability side, when you loan, you don't go and give the money to the bank down the street. What the central bank does is it creates that particular loan in the books of the particular bank maintained with the central bank, and this would be created in the form of reserves. So he would have now new reserves amounting to the loan amount, that is $100 million. So central bank side liability is created, asset is created, asset is the loan, liability is the reserves. In the banking system, the bank who borrowed from central bank, he has the liability, that is his borrowing from the central bank, that is the loan, which is a liability to the bank because he has to settle in the future, right? That is 100 million. And his assets is the reserves that the central bank has created on behalf of him. That reserves is, although in the central banks, belongs to the bank, so it's an asset in the bank's book. Reserves is a liability in the central bank book, but an asset in the bank's book. Loan is an asset in the central bank's book, a liability in the bank's book, because bank is borrowing from the central bank. And effectively, any loan the central bank extend would create a liability on the monetary base, right? And the amount of this liability is equivalent to the facility extended by the central bank. And monetary base, effectively C plus R, you see R is increasing here, increases by this amount of loan central bank extend to the financial institution. And apart from what I was mentioning in terms of purchase, sale, conversion, loan, there are other factors that also affect monetary base. One element is so-called float. This is an interim position. Okay, a float is nothing but money in the banking system that is briefly counted twice due to processing requirements. Today, this has been minimized to great extent because everything is electronic, very fast, real time. But still, this could be, for instance, checks being issued should effectively reduce the issuer's outstanding balances and should get increased in receivers' outstanding balances. But until it gets reflected, it might count both sides. But effectively today, the markets or the financial intermediaries have arranged ways through which they would not credit your account although you deposited check. Until it get realized, you will not get credited. So through which they can minimize any double counting possibilities. But it is a possibility that happens in financial markets. Okay. So float is created when a bank credits a customer's account as soon as check is deposited. But now they don't credit the customer's account until check get realized, not just deposited. However, it takes some time for the check to be received from the payer's bank. Until the check clears from the payer's bank, the amount of the check appears in the account of both recipient and the payer's bank. This is what I was trying to say. These floats are possible, technically possible, but today the financial intermediaries have ways and means to address these concerns. And then treasury deposits at the Fed Reserve. This also changes. Treasury, the government, they deposits with the central bank. What happens there is when the treasury deposits, by that amount, currency in circulation reduces. That comes back to the central bank. So the monetary base reduces. Then the intervention in the foreign exchange market. You sell, central banks sell foreign exchange because they wanted to maintain orderly foreign exchange market conditions. So the banks who buy foreign exchange from central bank has to pay in domestic currency. So by that amount, the currency in circulation decreases. And then because it's a foreign exchange related transaction, central bank would offset sterilized foreign exchange market transactions. So they have already sold foreign exchange. Because of this, currency in circulation or the money supply has reduced. So to counter that, they would buy from the market the government papers, securities, and inject the equivalent amount of money to offset the impact of foreign exchange market transaction. So it is a sterilized. Sterilization is injections that you get. So virus effect being minimized by the injection. So that's why they say sterilization in foreign exchange related transactions. There's a non-sterilized foreign exchange transaction also. So they do the foreign exchange market transaction, but there is no corresponding open market operations to counter that influence. So these are the other elements that also affect the central bank's monetary base, the overall monetary base in a country. So then we have the elements of deposit creation and gradually moving into the process of deriving the formula for deposit creation. And then we are going to the more appropriate point of money supply in our discussion. So I would prefer to stop at this point and start our discussion from this point in our next discussion. Any questions that you have? If not, we'll stop at this point and we'll start our next class from this point onwards for us to get this much more clearly clarified. Thank you.